Hello, everyone. Welcome to video 11 of chapter 4. We've been talking a lot about non-refundable credits. They are the biggest part of this chapter. This video, I'm going to talk about some refundable credits, credits where we can actually get that money back. There's not going to be any exercises related to these items. I'm mostly just going to talk about them in this video to get you a good understanding. Um, yeah, so let's get started. So here we have refundable credits. Refundable credits are paid and refunded to the taxpayer to extent not applied against gross federal taxes. So this money will apply against your taxes first, and once your tax payable gets to zero, anything that's left will be refunded to you. In comparison, non-refundable credits are only beneficial to the extent that a taxpayer has tax payable. So when it comes to non-refundable taxes, once you're payable, once your tax obligation gets to $0, anything that's left is lost. But refundable, you get the money back. The reason we have the thing about non-refundable credits is yes, they might be lost if you have no taxes owing, but next year you'll usually get a new batch. You'll get a new set. That basic personal amount will still be available. You'll have the age, you'll have the pension. So those credits that we don't get to refund now will get a new set next year to reduce our taxes again. Yeah. But if it's not used in the current year, those credits that are currently available are permanently lost. Okay, so the first refundable credit is the most common one. This is the GST HST credit. We mentioned way back in chapter 1 that there's progressive tax and there's regressive. So progressive tax rates apply a higher tax percentage the more income you make. So your effective tax, the tax you paid, divided by the entire income you earned will be a slightly higher percent for an individual who makes more money in a progressive system. Sales tax is often a regressive system, which means it hits lower income individuals harder. Pardon me, despite the fact that it's a regular rate of 13% in Ontario, it applies to money spent. So someone who's very wealthy, who covers their needs, pays for a number of recreational items and activities. And then a certain portion of their money they end up not spending. They put it aside, they save it. So despite the fact that sales tax would apply 13% evenly to both of them, the fact that one individual doesn't spend the money, it's partially, I guess, optional. Not optional, you still have to pay it if you spend it, but you can save sales tax by not buying things, is another word. But individuals who have low income, they need to buy certain things. So sales tax doesn't apply to, say, rent and groceries, but anything else that lower income individual needs to buy, like clothes or any other electronics or items that they might need in day-to-day life, will charge sales tax. So the total amount of sales tax they pay will make up more of their total income than a higher income individual. So to alleviate that stress, we have the GST HST credit. So this provides a relief for the impact of GST on low-income families, trying to mitigate that regressiveness of sales tax. So an eligible individual will get back $349 for sales tax. If they have a qualified dependent, so if they have a child, they'll get an additional $184. If their dependent is an eligible dependent tax credit, then they'll be upgraded to $349. So basically, I might get a benefit of $349. My spouse might get a credit of $349, but any additional children, we have $184. So the total of all credits gets reduced by 5% of the excess of an individual's income if the adjusted income's above 45,521. So basically that's saying the GST HST credit is meant for low income individuals. So if your income gets too high, and this is they qualify the household income. So if the household income gets too high, you'll start to lose that GST credit, and eventually you'll lose some of it and eventually lose it altogether. So the total of all credits reduces by 5% of the excess of an individual's adjusted income above 45,521. Refundable medical expenses. So medical expenses, I have to pay a certain amount of money for, if I'm sick, I have to pay a certain amount of money for prescriptions and doctor's appointments. But for a low income individual, they might need additional help beyond what the medical expense credit provides. So if you're over 18 on December 31st, you must have employment income or income from carrying on a business. So of at least 4,390. So in order to use this medical expense supplement, you need some income, but it works best for individuals who have low incomes. There's kind of this area where it provides the most relief. The credit is the lesser of $1,504 or 25/15ths of the medical expense tax credit claimed. So if I have a small medical expense, this helps increase its size, 25/15ths. You'll notice the numerator is bigger than the denominator. So we can just do that. 25 divided by 15 is 1.6. So you'll take your medical expense tax credit and you'll get a supplement of 1.6 times that medical expense credit. So for a lower income individual, this helps sort of not exaggerate or extend the relief that medical expense credit is providing. But that credit, this refundable credit's only available up to $1,504. Once the family net income grows above $33,000, this will again reduce by 5% of the income over that amount. So it will start to be eliminated at $33,000. It will be fully eliminated at $63,000. So this is for your full household income, the family net income. So Larry Fulton and his spouse have medical expenses of $5,000. He has net income of $30,900. The spouse's net income is $5,500. Since the spouse's net income is below the basic personal amount, they're probably not making use of the full medical expense credit. So we will claim the medical expenses in Larry's, return. Larry claims Canada caregiver tax credit for his mother, who has net income of $8,000. So the medical expense credit would be $5,000, the expense credits, the expenses for medical paid, minus our income threshold of 3% of the income of $30,900. Since Larry's income was this much, he can't claim more than 3%, or he can only claim the medical expenses above 3% of that volume, which 30,900 times 3%. So $927. So he spent $5,000. He has to get over the threshold of $927. So his medical expenses are $4,073 times 15% comes to about $611. There it is. His supplement would be the lesser of 1,504 or 25/15ths of his medical expense tax credit. So his tax credit was $611 times 25 divided by 15 means the supplement amount will be another $1,000. So he'll get the credit of 611, plus he'll get a refundable credit of an additional $1,000 to help make up for those medical expenses he paid. This $1,018 is reduced by 5% of the total household income. So that's him, the family net income. So that's him and his spouse over that $33,000. So 30,900 plus 5,500 minus 33,294. We are $3,100 over that income amount. So we'll grind that down at 5%. So we lost $155 of that calculated supplement. So our total refundable amount would be $863. So we get the credit of 611, that reduced our tax payable, and now we have another refundable amount of 863. So Larry's basic personal amount, spousal, Canada caregiver, and medical expense credits is 39,432. So when we add those credits together, he's getting tax credits at more than his income. This is more than his taxable income, so his net federal amount will be nil, will be nothing. So he will get back that $863 since none of it was needed to reduce the tax payable. So of his non-refundable tax credit, he's got way more than he needs to get his tax owing to zero. So this additional supplement amount will come back to him to help cover those medical expenses. The Canada's worker benefit, at minimum wage, individuals might be better off not working for reasons of social assistance payments, loss of subsidized housing. They qualify for certain programs, and earning over a certain amount, they might lose those programs. So what we have is something that's incentivizing someone not to work. So the Canada Workers Benefit came into place to hopefully help make up this difference. The purpose of credit is to make work more rewarding and attractive for Canadians already in the workforce. So to be eligible, you need to be over 19 and your working income needs to be more than $3,000. This can be employment, business, research grants. As long as your income's over $3,000, the amount of credit for a single individual is $1,633. So as long as you have some income, you'll get a refundable credit to help cover the gap. So at $3,000, we're talking about an income level of someone who is roughly not working and perhaps has just started to work. So this additional 1,633 can help cover certain bills, especially if we're trying to get them not off programs or perhaps accounting for the loss of some of the social programs they were benefiting from. If there's a family with spouses and eligible dependents, this maximum increases to $2,831. A single person doesn't need as much assistance as a family might. The eligible educator school supply. If I was a teacher at an elementary school, it's expected that I might pay for certain items around the class, perhaps some books, decorations, markers, general supplies. So I can get a refundable tax of 25% up to $1,000 that I've spent. So if I spend $1,000, I can get $250 back on my taxes. Now, to qualify, the games have to be the following goods and consumable goods. It can be games and puzzles, supplementary books for the classroom, perhaps educational software, webcams and microphones that might work with computers for children to work on, construction paper for activities, flashcards, activity centers, or items that we get for science experiments, such as seeds and potting soil, as many of us probably remember doing that, growing a seed and seeing its progress experiment. So things you buy for the classroom to support the education of students, you can get 25% back on the first $1,000 spent. But in order to get the credit, you need to be employed in Canada. You need to have a valid teacher's certificate, and the early childhood educator needs either a teacher's certificate or a diploma. So you need to be employed in Canada as a teacher, and you need to be, so your function needs to be as a teacher educated individual. So someone who's working for a school as, say, a custodian won't get this credit, this benefit, because despite working for a school, they don't have a valid teacher certificate from Canada. So they're not working as a teacher. We have a Canada carbon rebate. So the Canada carbon rebate's available in 8 of our provinces, the ones that are not using the federal carbon tax rate. The federal government introduced the Greenhouse Gas Pollution Act. The federal fuel charge applies to those 8 provinces. So any province that doesn't have its own carbon mitigation policy uses the federal tax rate. I think this has been recently removed. Yeah, Yeah, on March 15th, 2025, the Liberals announced a cancellation of the carbon rebate for individuals and small and medium-sized businesses. So large companies still pay this carbon tax amount. With the cancellation of the carbon tax rebate, individuals will only be entitled to the April 2025 rebate payment. So it's just modifying the rebate. So what it was is businesses would pay additional charges. I guess everyone would pay the additional charges for using gas and fuel to counteract, it doesn't counteract, but to encourage limited use of fuel and carbon products. So they would collect the amount on the purchase and use of fuel, and then the amount collected would be redistributed to taxpayers as part of the rebate. So since they ended the carbon tax in March, the rebate only applies up to April. So they collected carbon taxes, but those carbon taxes were used to give back to individual taxpayers. We have a new proposed carbon rebate for small and medium businesses, but because this is sort of still in flux, I'm not going to focus too much on it. The Canada Training Credit. So tuition amounts paid to educational institutions outside of Canada do not qualify for the training credit. It equals to 1/2 of tuition costs incurred in the current year that are eligible for the tuition payment. Individuals' annual training limit was $1,500. Does it go into this? This credit was specifically to help in 2020 when a lot of people were being let go. The training credit was to help individuals or help encourage individuals to go back to school to improve their professional skills or perhaps advance their training skills to be able to get more lucrative positions. We're trying to encourage people to be more educated. So to be eligible, the individual must have filed an income tax return in the preceding year. They must be a Canadian resident between the ages of 26 and 65. So this was roughly the age of people who were displaced out of their positions, but still of an age that they could retrain and then rejoin the workforce. Their earnings of the prior year needed to be at least 11,821, because again, this credit was meant for working individuals who had lost their position and retraining them for a new position. So you needed to file a tax return with a certain amount of income to show that you were employed, and the income could not exceed 173,000. After 173,000, your income's high enough and it's lucrative enough that you probably wouldn't want to be training for a higher priority or higher executive level job. If you were, your compensation for that will more than make up for the additional training costs. But someone below this amount, between 11,000 and 173, they could use their work experience, do additional training, and perhaps go back in a higher position, perhaps managing a warehouse floor that before they were a worker on. And the final refund we'll discuss now is the multi-generational home reno tax. Housing is getting pretty expensive. And so to assist with individuals who are wanting to renovate their house to be multi-generational, so they can fit more family members or, an in-law suite. This objective is to assist Canadians with renovating, altering, or adding a housing unit situated in Canada with the purpose of creating a secondary unit for a qualifying individual. A qualifying individual usually being someone you are related to live with you. To live together with qualifying relations being usually spouse or common law partners. So this allows a family member associated with a married couple or common law couple to live with them. This tax credit can be claimed by an eligible individual to a maximum of 15% of $50,000 spent to renovate the place to allow an in-law, we call them in-law suites, but a small living area for an additional family member. In order to qualify, it has to be a family member that's moving into it. You can't just renovate a house to rent out. To qualify for this specific renovation credit, you need to be modifying the home so a family member can live with you. Okay, so that was my 20-minute summary of these refundable tax credits. Like I said, there's not too many There's not really a calculation we expect you to know related to them, but be aware of what credits are refundable because a question might come up in that style. We likely won't ask you to quantify the credit, but if you have a general idea of when the rules apply, I think that should be sufficient to get a decent grade in this course or to meet the expectations of this course. Anyway, there is one more video for chapter 4, and then we will be all done. So thank you for your time, and I'll see you in that last video.